Good morning, everyone. It is July 18th, 2023. The bank earnings parade continues this morning. The analysts were busy downgrading stocks last night. I'm going to go through one group of them, and retail sales numbers for June are hot off the press. We'll go through that as well as some implications, and I'm going to give you one more thing that I'm watching to make it four things that I'm watching this morning. This one is a little bit further down the road, and yeah, that's a hint. So let's jump into it right now. XLF. We talked about this just yesterday and again last week. The financials have been on a tear over the last 10 to 15 trading days, as we've seen a rally anywhere from 8 to 20%, depending upon the bank that you're looking at. Now, we're starting to see the rubber hit the road as banks are coming out with the earnings results. This morning, it was Bank of America. It was also PNC and Schwab and a few others. And after the close today, you get WAL. That's going to be a big one because it's been high on the regional bank watch list. But let's go through the three companies I just mentioned. Bank of America, not much to see here. You've got BAC coming in, Brian Moynihan actually beating expectations, a little bit boring. And remember, they're at the bigger end of the bank cycle or the bigger end of the bank spectrum here. So they're going to be boring, but boring has been good. It's been keeping it in a trading range. Bank of America, not high on my list of the companies that I'm likely to see move for a trade here. You know what is high though? Schwab, SCHW. Charles Schwab comes out and announces that they opened up more accounts than they expected, and it wasn't all IRA business. Remember, we just got done with tax season, so a lot of those accounts typically in this quarter are contributed to tax planning, your IRAs, that type of thing. It wasn't just that. They saw new money coming into Schwab's ecosphere from other banks. Now, Schwab was one of those companies that got pulled down with the rest of the regional banks, and rightly so. We looked at it as a regional bank, and that's what it is. But remember, they make their money off operations on the trading side more than anything. Not out there doing the same thing that Fifth Third Bank does or PNC, which I'm going to talk about in a second. So when interest rates go higher, what can you do at Schwab? You can find another vehicle that's going to pay you higher interest rates. When interest rates go higher at Fifth Third, what are you going to do? You might end up pulling some of your money out of Fifth Third and going to someone like Schwab to get a higher yield on your money. Now, I'm not bashing Fifth Third. I smile when I say it because it's here in my hometown. Nonetheless, that's the difference between the two. Schwab benefiting. And what they also did last quarter is they lowered their expectations looking forward. A lot of the banks did that. They just beat those lower expectations. You can usually get away with that for a quarter or two. Right now, with the stock trading right below $60, I expect us to see it at $65 as long as we don't get that strong headwind of the sell the news type of activity after these announcements. And I do believe we will, but nonetheless, Schwab, one of those best in breed names in the financials. Let's look at the other side of the tally, though, because there's another company, PNC, that this morning is going the opposite direction. PNC shares are trading about 3% lower, and you can notice that it's been trading in a tight range with $124 at the bottom of that range. PNC missed on their revenue guidance from last quarter. So in other words, the money that they were bringing in from their operations did not hit Wall Street's expectations. Why? Well, think about the equation I just gave you, folks. Higher interest rates, deposits possibly going out to try to find something that's going to pay a higher yield, and they're not making as much in terms of getting loans out there. At the same time that these rates are going higher, they're seeing fewer mortgages get initiated. They are seeing some HELOC business, but PNC really isn't into that HELOC business, and they're getting perhaps lower demand for consumer loans. We'll talk about that in just a second with the retail sales numbers. So PNC misses that top line. They hit the bottom line, but their expectations for the next quarter, not looking great as they lowered their guidance. Right now, the 50-day moving average is what I'm going to be watching at 122. Also put this under the same banner as the sell the news. We got a little bit of a rally here from 122 to 130 on PNC. Not quite 10%, about 6% or so. Don't exclude it from the sell the news type of activity that we're likely to see in the financials. That will take it back below the 50-day moving average. It's in the regional banks, so it'll have a little more pressure. I expect to see us trade down to a 112 to 118 on PNC. Now, next one that I want to look at is somebody that is going to report after the close today, and that is Western Alliance, WAL. It is going to be in the hot seat because the regionals have been represented, or at least the risky regionals have been represented well by WAL. Stock has been trading sideways, but we got a little bit of a bump here up to the $40 level. That is a make or break level with, again, the 50-day, just like PNC, being that trapdoor where we'll see more sellers coming in. We'll hit a few more of the companies, just a couple that are going to announce, but right now, I want to talk about the analyst activity that happened last night. Companies like Shopify, companies like Camping World Holdings, which you're going to see here, which all of these have been going through the roof. You've got also Norwegian Cruise Lines, NCLH, MarineMax, HZO, and then Activision. I'm going to set Activision aside. Let's talk about Shopify, Camping World Holdings, Norwegian Cruise Lines, and then MarineMax. They all have one thing in common, and that is the consumer. The consumer. All of these were downgraded by Wall Street firms last night, and it is a little bit of an outlook on what's going on in the retail area and what's going on with the consumer. To give you an idea, I always love to do my walk down Main Street. Last night, I went to the Kroger. Typical Kroger visit for me. Maybe put 12, 13 things in my basket, along with maybe a couple prescriptions or something. I ended up walking out for $140 from that trip. I think we're all getting hit with a little bit of sticker shock from that inflation that is supposedly going lower. Remember, lower inflation doesn't mean that the prices are coming down. They're staying steady, and a lot of us are still getting acclimated to that, and it's catching up in the large consumer discretionary areas. Campers, cars, boats, etc. These are going to be on the hot seat over the next few months. Look at what happened with Ford yesterday. Ford announcing that they are lowering the price of that F-150 Lightning, the truck that is so hot that everybody wants to get it. GM is going to follow suit here as well. It's great that they're getting the EVs, but high interest rate loans, as well as people kind of looking at that checkbook and saying, can we really afford a $600 or $700 a month car payment? It's going to start to ebb some of this demand. I told you that I'd give you something to go down the road. Let's look at what that is, because it's right along the same message. Manheim Vehicle Value Index. This comes out every month, and the month of June saw a 14% decline in that used car index. This is basically telling us that the price of used cars are coming down, and they're coming down quickly. Last decrease that we saw that was this large was pandemic related. So the used car market is starting to lose a little bit of its froth here. That is going to trickle down and increase inventories. How do you trade that? You look at companies like Carvana, you look at Car Gurus, and CarMax. KMX is the other ticker symbol that you look at. Right there it is for you. All of these have been trading, especially Carvana, at elevated levels as we've seen the consumer out there spending money. Watch for a little bit of a sign that these could start to slow. And how does that come? Well, retail sales, as I mentioned, were out this morning. They came in lower than expected, as we saw the retail sales activity come in at 0.2%. So 0.2% increase in retail activity. That's against an expectation of 0.6% from the market. So we only did a third in terms of the activity, and we're starting to head towards some lower, maybe even break-even numbers. Back to school is going to be on the horizon here over the next couple of weeks here. We'll see some of those teen retailers like American Eagle Outfitters, Abercrombie & Fitch get a little bit of a bid, but watch for a couple of companies like Walmart. Get back down. When you go down Main Street here, take a look at some of the companies that are a little more likely to be the staples companies as we hit back to school. There you've got it. We hit the cars. Manheim Auto, the value index coming down, telling us the used car market is softening. Maybe take a look at some of these resale related companies down the road. The banks, I'm looking at Western Alliance this afternoon, but Schwab makes my hot list. PNC, they fell out of that. Watch for them to break a little bit lower, and then keep an eye on your consumer discretionaries as the analysts are busy downgrading this sector of the market. I'll be back with you tomorrow on 3 things that I'm watching. Have a great day, and I wish you the best trading success.